Well, the market is cheering for the rally. Is this just a bear market rally? Is it going to turn over? Well, there's a lot of signals saying that this could be the bottom, but I got some stuff to go over today to look at both positive and negative aspects of what's taking place. I have a whole lot of data today, so we're getting into it, okay? First and foremost, this chart was pointed out to me from a Discord community member, Che. So thank you for posting this out, because as soon as I saw it, each one of these red dots here actually reminded me of something that happened in history, and I'm going to show you what those things were momentarily. Okay, so first and foremost, what are those dots on the screen? Well, that is when we had 3 consecutive sessions of New York Stock Exchange upside volume greater than 80%. And that, at first glance, you'd be like, oh, wow, it happened, and then we marked bottoms. It happened, and we marked bottoms. But guess what, other than this time right here? Each one of these times came on what's known as a Fed. I'm not going to spell it out. I'll spell it out all the way. Fed pivot. Okay, so let me highlight these for you. What's really going on here? Well, first and foremost, let's talk about the oops factor over here. First, there wasn't really a Fed pivot at this particular one. This was where QE1 was announced, but nothing was really done up until later where QE1 was expanded. That was the pivot. So they got excited on the news, ran it up, but then we saw that big drop in 2008 during the financial crisis. We started rallying up and we started the market selling off again. Guess what? This was at near Jackson Hole where Bernanke he hinted towards quantitative easing too. Shortly thereafter, it was announced. The market ran after marking that bottom and seeing those 3 consecutive sessions. And then market started selling off. Operation Twist was announced. Bam, another 3 consecutive sessions. Over here was actually when we were seeing a lot of China stock market turbulence. And I believe Janet Yellen actually had some sort of pivot in that time. Okay, and then right here, right, the pandemic crash, well, the Fed made the pivot very quickly and acted fast for quantitative easing, basically unlimited. Okay, so right here and right here, in my opinion, are actually very similar because we actually didn't see a Fed pivot until later. Now, some might argue, no, there was a Fed pivot over here. It was when the Fed Bostic recently just said on the FOMC minutes, or shortly thereafter, that a Fed rate hike pause in September may make sense. But let's be real, that's not Powell, okay? Interesting quote from Danielle DiMartino Booth. She said, I think Powell has grown himself a pair. I think he's going full Volcker. If you don't know who she is, she's the author of Fed Up. Great book if you want to listen to that on audio. Okay, now Jerome Powell was recently got, the vote took place, right? He's in his 2nd term. And as soon as that, all that was over, he basically hit a bunch of different news outlets, right? There's some podcasts on him. I believe NPR had a conversation with him, Marketplace. Well, Barron's wrote an article saying that he's warning that soft landing could be quite challenging, okay? One of the quotes from this article says this: I will also say that the progress of getting inflation down to 2% will also include some pain. Okay, but ultimately, the most painful thing that would be if we were to fail to deal with it and inflation were to get entrenched in the economy at high levels, and we know what that's like. If that happened, people would lose the value of their paychecks to inflation, and ultimately, we'd have to go through a much deeper downturn. So we really need to avoid that, he added. Okay, so he seems very serious here, like he's not going to be pivoting, right? But these could just be words. But also here at Marketplace on this interview, he stated that whether we can execute a soft landing or not, it may actually depend on factors that we do not control. These seem like warning shots, and he seems like he's very serious to get inflation down. Now, recently, right, the Fed minutes came out and it points to more rate hikes that go further than the market anticipates. However, the market actually rallied on that news shortly thereafter, which reminds me of when the press conference was earlier in the month that the market also rallied because the Fed said it wasn't considering rates increasing rates by 75 basis points. Next week, we have quantitative tightening taking place. Starting on June 1st, the Fed will begin to reduce the size of their balance sheet, conduct quantitative tightening to amplify contradictory impact of higher interest rates. Now, we know how the market responded with just unlimited quantitative easing, how is the market going to respond to quantitative tightening? Do you really think it's going to do the same thing? If you do, then we're at the early stages of a brand new bull market, right? If that's the case. But however, if we look at some data, the consumer is not doing all too hot. We're looking at a consumer sentiment survey, and it's at its lowest point here in 10 years, I believe it is. And I believe it's even lower if we go 25 max, but 10 year, we're at a 10-year low. If we take that even deeper, here's a chart from Hedgeye. We just reached an all-time high here in consumer credit, 52.4 billion in the month of March. Okay, cost of living is up, consumption capacity down, consumer credit is going way up. So consumer credit's going way up. What is this doing with savings? Well, savings right now is at the lowest level since 2008. Jim Bianco posted this. This signals the public is spending a large percentage of their income on disposable goods, keeping up with rising prices due to inflation. You gotta wonder, is Jerome Powell going to pivot? And at what point? Well, Daniel DiMartino Booths believe that the Fed pivot is a lot lower than what the market actually believe it is, which could tell us that this market is in for some more downside price action. That's despite seeing a strong 2-day, 3-day rally that we just recently discussed. Now, I wanted to highlight this 15-minute chart because if this is a bottom, well, we need to prepare ourselves to at least try to execute some trades. Now, I found this very interesting. We applied an anchored VWAP to two specific levels, both on the Fed press conference when the announcement came out, and then also the Fed minutes. Okay, this is very interesting. So first and foremost, the Fed press conference over here, right? We just started rallying on the news about the, 0.75 basis points, which by the way, we did 0.5 and we haven't done that for like 22 years. Okay, so the market saw this as good news. However, we rallied up and then we gapped down through that anchored VWAP, and that was when we saw a lot of turbulence to the downside. We tried to gap back up through it, it tested as support, and then we gap right back down through it, okay? Then when the FOMC minutes released, we came back tested it, pulled back into where the the anchored VWAP of the Fed minutes, and then we started rallying significantly higher. This market has been on a monster tear here, especially looking at these 15-minute time frames, but this is something that we've seen prior. We saw it right here. So if you are bullish right now, as we're cracking some key levels from the downside, look for potential pullbacks to have a better risk to reward, because these type of squeezes, they can very well go higher. At some point, we're going to have to digest those gains. We don't know if this is short covering. My guess and belief would be we have a lot of short covering taking place, okay? Because to me, there's not too much to be bullish on, which could be a reason to be bullish, I guess, right? But if the market starts pulling down, start looking at potentially the 5-day moving average, this previous anchored VWAP right at around 4,000, and then also 4,066 to see here if price action gets below it, and if we get back right up it and show some strength, that could be a potential entry point to see if the market wants to continue to perpetuate itself to the upside. Now, there's another interesting chart here that I found on Twitter. Actually, I didn't find this on Twitter. I heard this from Scott St. Clair talk about this, and this is showing all the recessions and big bear market sell-offs that took place looking back, 25 years. And what you'll notice here is that we are in a bear market, but we don't have any signs of capitulation. So for example, we're looking at VIX at the level of 40, okay? During the pandemic, we fired off. During the China stock market turbulence, which we recently discussed, we fired off. Operation Twist, we fired off. QE2, we fired off. Financial crisis, .com, LTCM, right? That long-term capital management, all those times we blew past the 40 marker. And like I showed you already, right here, this is a pretty severe sell-off that we're seeing, and there is no hint, at least as of now, as a Fed pivot. Okay, so we actually have yet to see all these times we were seeing the VIX fire off, right, above that 40 marker, and yet we still are at elevated levels, trending, right, higher lows, okay? The volatility is still high. We're at 25.72, okay, and that's just VIX volatility. We have Russell volatility, and we also have, let me show you, Actually, I have that chart. We have Russell volatility right here. It's still above 30. And on top of that, we have NASDAQ volatility that's still above 32 that hasn't fired off. So this to me tells me that there's still a possibility that we can see capitulation. And now I like to look at various gaps in the VIX because it's my belief that these gaps get filled, okay? And the majority of them have been getting filled. However, this one right here, it's a hidden gap in April, okay, of I believe this was 2021. I now have to look at this specific year, but there is an open gap right there between 44 and 46. So if the market fires off or to the downside and the VIX fires off, this could be a gap that can act as a level of resistance that just has not gotten filled yet. Okay, so that is one thing that I'm paying attention to moving forward. Now, year to date, if we look at what price action's been doing in the 11 sectors, the number one sector has been energy. It's up 61% year to date. This thing has been firing off, okay? So yeah, inflation, oil, right? And rising oil is helping some of these energy stocks. Can this get hit? Well, it hasn't yet, but it has been the strongest performer. But if you look down the list here, XLU and XLP, these are defensive sectors. This is when you start to see things turn, right? And we're seeing utilities is the second sector. The only there's only two sectors that are in the green year to date. That's utilities up 6%, and then energy, right? And then consumer staples is in third place, which is down 2.3, and that's even coming after a strong hit to the downside because consumers were hit hard in this previous recent week. A couple of weeks. Now, if we take a look at the week to date, what took place this last trading week, well, we saw this big bear market rally. It's a bear market rally until it's proven innocent, right? And guess what led the way? Consumer discretionary, financials, technology, well, and of course, energy. These are the three horsemen. We have technology, financials, and consumer discretionary. You're going to get big rips in the market. And these are, nothing to balk at sort of type of moves. Almost up 10% in consumer discretionary. Financials were up 8%, and then technology was up around 8%. Now, I find this interesting. Financials, I don't have the chart in front of me. Actually, I do. I'm going to do that right now. So I have this right here, the chairman, Charles R. Schwab, and he is selling his stock in Charles Schwab. It's been a while since he sold a little bit. You can see here, these are the blue vertical lines are the times that it's been highlighted that he has made those sell orders. And you can see he got out right here before really the market started downturning. And now as the market's ripping up, it's been a while since he sold some. And he's one of the elite, right? Big wealthy guy over here, big timer, and he's selling into this rip. Now, is that going to make financials turn around? I don't know, but hey, perhaps he knows something that we do not, so that's why I'm pointing it out. Now, consumer discretionary, right? Just look at the size of this 3-day rally. This to me looks like all the makings of a squeeze, of a short squeeze, and it's getting ripped up. But overall, you got to understand that it is still broken from key levels, and we haven't even back tested it yet. So can the market run back up here? What would that do? Well, that wouldn't do much. Honestly, it would be a high, lower high, lower high, and this would bring in so much FOMO, and that's a big move, especially if you were talking 155 up to potentially 180 on this trend to backtest the 200-day moving average. That is a big move, and we could be a part of it. But I would still be hesitant. Look for pullbacks, okay? Because if you're not looking for pullbacks and you're just buying in, and then all of a sudden, gaps down and rips down lower, it's going to hurt you. So you got to always manage your risk. Okay, now the consumer, right? This is consumer discretionary, but I already talked about consumer sentiment not being good at all, right? And then you take a look at oil, and oil continues to press higher up into this 115. This is interesting, right? We had a trend line hit here. Then we had a shallow pullback, okay, right back up to the 115, which tells me that could be an early indication that we're going to be breaking to the upside. Now, do you think that that's going to benefit the consumer? No, I personally don't if that's going to be the case. And a move to 120 would put more, pressure on gas prices and more pressure on the consumer, which, by the way, is not good for the consumer. It's not good for retail. It's not good for consumer discretionary. And you can see that because at the rate at which this moves up, take a look at what happens to the relative strength line between XLY and SPY. It goes down. Oil goes up, the consumer goes down, okay? Kind of makes sense. Now, another thing to watch is the dollar. The dollar has been pulling back, and that could be putting fuel to the fire of this move to the upside. Go figure, right? The S&P 500 rips up, the dollar pulls down. I do want to call out a couple levels here and a couple, technical things on the dollar. First and foremost, it is a wedge pattern right here. So if we start breaking above 102, that opens the door to go potentially test that 105 and retest it. However, if the dollar starts breaking down from this falling wedge, start looking here at around 99 to 100 as a back test, because still, even if that happens and the S&P 500 pulls up to around 4,300, to me, the dollar is still trending up. It'll bounce at some point, and that could put pressure on the market, still continuing that pattern of lower highs and lower lows. All right, got to be aware. Now, there are some bullish things that are taking place. For example, this big breadth thrust on the NYMO. I mean, we're talking it reached 105. That is a big move. We haven't seen something like that since coming off the pandemic bottom. Now, something that I found interesting was we hit a low, a higher low, right? And then we got that breadth thrust. Well, we hit a low, we hit a higher low, and then we got a similar type breadth thrust. So we could very well be trying to find some sort of bottom, but be mindful that these big moves, okay, highlighted with these blue vertical lines, we saw pullbacks, significant pullbacks, right? We had big squeezes and then pullbacks. So it was a very hard trading environment. So if we are going to be heading back up, you can potentially, if we start seeing more breadth thrusts like this, you can maybe expect to see a lot more volatility, and it could be try to shake out people, right? Bull markets, they climb a wall of worry. So you just got to be understanding of that. All I'd be really paying close attention to here is the low, right? If we start taking out that low, buckle up. It could get pretty bad. The summation index, right? We talked about when this parabolic SAR is going to start underticking, could lead a new up move. Well, guess what? It's starting to turn back up. It's still well below zero, right? Nothing really good happens with the summation index below zero. It's been down through zero basically this entire time, and you can see it's been heading a lot lower, okay? And now we're starting to get a big move here, about 350 reading, which is extremely high on the NYMO. I haven't seen that for a while, so that is getting a little overextended, if I do say so myself. Pring bottom Fisher, that turned over bullish, and we're starting to get that ramp up too, all right? It wasn't as deep as I thought it might get, but it turned over. It gave us the insight saying basically what? It says, hey, this isn't the area to really short. Wait to see what really takes place. The Cohan high low, this also hit a bottom, which marks many bottoms. However, during the 2008 time, it marked, bear market rallies before selling off further and then also catching that bottom. But it's caught in the long-term capital management. It caught the dot-com bust. It caught over here in 2016 during the stock market turbulence, right, which we discussed. And then over here during the repo fiasco here and, the Christmas Eve nightmare going into 2019, okay, and then also the pandemic too. So we're back at that level, and we're kind of bouncing from it. We also talked about the positive divergence in the XVG. Okay, we said we put in a higher low, lower low, and now we're starting to see that rally from it. Okay, that and the IWM put in a higher low. That was a divergence, and it was a divergence that played out to the upside. Couple other things to watch out for is the BPSPX chart. Okay, there's still room to potentially run here, right? It's not overextended to the downside. Remember, we said when it gets down here, we like to look and not really short into that, but when it starts moving up, then you could start looking for potential shorts, okay? But that's not just BPSPX. BPNDX is even closer to being overextended. BPCOMPQ, which is the NASDAQ composite, still got more room to go. And then a couple of indicators that haven't confirmed a bottom yet is the NASDAQ record high percent index. Okay, so it's still below here. You want to see it cross back up through 35. Every time it has, boom, 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 and boom. That has marked those bottoms pretty spot on for the most part, and we just haven't got there yet. Another one that hasn't been confirmed yet is the old fool indicator. You want to see this green line start to cross back up through the blue line. We tried to over here during this last bear market rally, but it was not sustained. It crossed back down through, and we started selling off further, taking out that low. So are we seeing something potentially similar like that where it could potentially take out this low? Well, we just got to keep an eye on that low, keep an eye on these indicators here. Another indicator is the lumber to gold ratio developed by Michael Gayad. It is still saying, hey, take your foot off the gas, right? We are in a risk off environment as it stands right now. The line crossed down through zero right over here, and well, we're down since that cross down. Okay. Now let's hop into some of the charts. So this is the SPY. We talk about expected moves and what the market's going to price in. Well, it has been falling 68% of the time, actually more this entire year. It has been landing within the risk range. Okay, this week it almost blew two standard deviations, basically two standard deviations outside of the risk range. And this right here is a significant move. And this is what we talk about when, if it gets outside of it, new hedging could take place, buying into more buying, or even, selling into more selling can take place if it gets way outside of the downside. But finish two standard deviations to the upside of it. Now, where's the new weekly risk range? Take a look. This is the new week, old week, new week. So we have a higher high, a higher low in the risk range, and it kind of contracted a little bit. That could be because it's a holiday weekend, so there's less time in the market. So where can this go to the upper end? 425. 425 is also in confluence with a declining 50-day moving average. So that is what we need to be paying attention to. Okay. Now let's continue on to a little bit closer so you can get a good idea as to where the downside is, which is right at around 405. That would fill the gap, so that'd be the confluence, and it's right by the 20-period moving average. So a move like that could offer up a good area of support if you are looking to go long. Alrighty, now I want to look at the weekly time frame too. Now the weekly time frame, I want to point out some stuff with volume, and I'll go back to the daily to show you, but you can see closed at the high of the week. It was up 6.58%. Huge move, right? But you can see on declining volume. So the volume police are sending out the sirens. Now, where is a key level to watch? 430. Why 430? There's big shooting star type candle here. It showed that, when the bulls were here, when it was a big green candle, they stepped in and they sold it off. So right here is going to be some trapped supply and shows an area of resistance. So if this comes up here, keep an eye on that level. I would get more bullish if it starts closing up above 430, but we got to be mindful that we're still below declining moving averages there too as well. When you look at the daily time frame, I want to also point out that this big move, this big rally is doing so on pretty lackluster volume. And on top of that, these bottom like candles, right? That was on lackluster volume. So overall, something seems to be a little bit fishy here. Just taking a look at this. I want to look at the VIX really quick. The VIX, as we stated, right, broke this trend line, came down, filled the gap. It's at this lower area. And we're not too far from filling this gap here. We have another gap that's farther down below us, but we do see a little bit of a positive divergence forming right here. So the RSI is getting a little crispy right there, getting burnt out. We have a low, a lower low, a high, a higher low, which tells me that there's a possibility to send this to the upside. So we'll continue to monitor that. Now, on the 15-minute time frame, you can see here, it is getting overextended on the RSI. If it comes up here, we do have that open gap. We broke that down sloping trend line. So this is all good, but just be mindful of the price action, right? So the Fed, we talked about the Fed press conference, right, on the 0.75 not doing it. Bam, the market rallied, sold right off. Bam, rally, sold off. Bam, rally, sold off. Bam, 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 right? It's very, very volatile price action just by looking at this chart. So be mindful for pullbacks, all right? As 5-day period average moves up, pullbacks if you are looking for some sort of bounce, okay? Now, HYG. HYG is another one to watch, right? This was a monster squeeze to this upper trend line right here, okay? A monster squeeze, and they typically have a strong correlation. HYG, high yield, has a strong correlation with the SPY. I just want to call out that it is running into an area of resistance. So you got to wonder, are the big players, are they going to use this opportunity to get out of their high yield positions if they haven't got out earlier, right? Are they going to take this liquidity, take this move, right, and sell into it as we're coming into resistance? And are people that are short HYG, are they going to be stepping in right here to potentially re-hedge or add into short positions? I can tell you one thing, I still am holding my short position in HYG, SPY, and IWM at this particular time. They are smaller positions for the most part. My IWM, it's a full-size position, but my short positions are significantly less. My full-size short positions are significantly less than any of my long positions. Another chart that I found interesting was the HGX. The HGX is also coming off a very big bottom. We had a positive divergence here and in the relative strength line, but take a look, it is coming right into a downsloping trend line. So we'll see here if that wants to start breaking out as well. If we hop into the Qs also bursted right through its weekly expected move, squeezed outside of it. This week, you can see higher high, higher low. If we zoom in over here, you can see it's at around 320, which matches up with these prior areas of prior support. So to see it come up here, maybe even higher to the 50-day moving average is a strong possibility. To the downside, it would be that gap fill right down here to around 300, okay? Also note the volume's kind of lackluster as it's been ripping up higher. Volume's been dying off, but on a positive note, RSI is ticking above that 50, and we have that MACD curling up too as well. If we take a look at the weekly time frame, we're talking 1, 2, 3, 4, 5, 6, 7 weeks to the downside, and then finally we're getting a move to the upside. Yes, it's on lackluster volume. Be skeptical about that, but that doesn't mean that just because we have low volume, it can't come in later. So, we could very well head a little bit higher, 320, 330, but we've got to see how price action reacts in those levels. The move was aggressive, just like this SPY. So these are not type of areas where I just enter into. Me personally, all right, like I was talking about the SPY being short and IWM being short, I entered in at the... I entered both Friday because I re-added in my IWM short, and then on Thursday too, I basically did IWM at the high of day, and then once again, I added into that short at the high of day, close to around the high of day, creating a full-size short position in IWM just to have some exposure to the downside on a pullback. But I am remaining optimistic for a rally or a potential bottom because I am seeing a lot of good chart setups out there for the swing trade community. Now, a couple things that I also want to call out is this. The big dogs of tech, the charts have been broken and they have not been recovered. So that's why I'm saying be skeptical of this bounce, right? We broke down through 2,500. We haven't even back tested it yet. That right there, that move alone, if we were to go up that high that fast, is going to bring in a lot of confidence into bulls. But be mindful that the chart is still broken. Microsoft, very same situation. Big move up, lower volume, but the chart has broke some key levels. So we need to see how price reacts. This is not something that I would just hop right into. You got to be patient. You got to wait for bases to form, or you need to see bottoms actually take place, right? Like we said, quantitative tightening starts. There has been no Fed pivot yet. This could very well be a bear market rally. Apple, same situation. Hasn't really been getting hit too much, but we did break down to some key levels, and we're starting to see a relief bounce. And then another one is Tesla. Big, nice, bullish type 2 candlestick pattern right here, gap down, and then close way up into it, signaling that we could very well rally higher. It was up 14.42% on the week, but we have been cracking down some key levels, right? It was just, a little bit ago, it was down to around 600. And, when we were up here, people were thinking, yeah, right, it can't reach 700. And then we reached down to 600. And now we're seeing a rally take place, but we're below a lot of key moving averages. I want to quickly hop into Bitcoin and then end on a interesting statistic. Bitcoin, we're still below on the Saylor to Schiff ratio, below 0, right? Now, this is interesting. We saw a big move up this week in all the indices. Now, on Bitcoin, that's not the case. So is Bitcoin going to follow? Well, Bitcoin has been actually somewhat of a leading indicator. So this is actually a little bit of a red flag to me. Okay, we had 1 week down, 2, 3, 4, 5, 6, 7, 8, and we're working on our 9 week down. You would think that we'd see some sort of counter trend bounce here at some point. But we haven't yet, and the Saylor to Schiff tool is still pointing down. Now, if we take a look at the daily time frame, right, it broke down from the bear flag, and it's been really just going sideways here. Relative strength looks poor. Overall, the chart looks poor, right? And if we zoom in even closer, I want to just point out that price action is getting very, very tight. So we can either see an upside break to around that 31, 32,000 before we hit more resistance, or we start cracking down through 28,000, and that opens the door to retest this prior low over here. All right, Ethereum showed more weakness than Bitcoin, and we came to retest this prior low. Bitcoin has not done that yet, and now we're starting to see a little bit of movement up. We're up 3.54%, but we haven't cracked, we haven't even back tested this. It's a broken chart right now, but it's still holding this support, which, by the way, these levels, very important. Over, if you look onto the left of the chart further, there's actually been tags there multiple times. So if this starts giving way, that opens the door for more downside. Now, as far as the interesting statistic, right? The S&P 500 finished up over 6% on the week. These are big weekly gains, tend to mark the start of more strength. So on a bullish note here, let's take this into consideration. Greater than 6% weekly gains for the S&P 500 index. This is looking from 1950s to current. You can see here, March 18th, 2022, May 27th, 2022, right? We had that boom, 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 big up week, big up week. We don't know yet what happens 3 months, 6 months, and 12 months later. But if you look overall, the average and the medium typically is good. It's typically in the green. However, there's been one time where it doesn't look all too hot, and that is the great financial crisis. So you got to wonder, is the Fed going to pivot, and are we going to see some follow through, some good green weeks, or are we headed into a deeper recession if we're not already in it, or some more pain in the stock market? I'm going to leave you with that, everybody. Hope today's information gave you some insight into what I'm seeing in the markets. I'll see you back here on the next episode. See you later.